connected to Business Wrap, inspiring ideas that propel the business community forward. Today, gain a deeper understanding of business during part 1 of our roundtable discussion with Tony Cuthbert. Hear daily communication advice from Phil Zeller of Dale Carnegie, Michigan. Consume news that impacts business with Michael Patrick Shields. And join us for the conclusion of our roundtable discussion. In studio now, Tony Cuthbert.
And today we talk investing in multifamily real estate here on the Business Wrap. Our experts today are
Kim Laforet with Coldwell Banker Hubbell Briarwood and the Laforet team.
Luke Mardigian with the Mardigian Agency, Farm Bureau Insurance.
John Mashner with the law firm of Foster, Swift, Collins & Smith.
Scott Danek, Equanimity Wealth Management with securities offered through Cetera Advisor Networks, LLC, member FINRA, SIPC, and advisory services offered through CWM, LLC, and SEC Registered Investment Advisor, a separate entity.
Multifamily properties are buildings with more than one unit and range from a duplex to hundreds of units inside of an apartment complex. The considerations that you should make before investing in this real estate, that's what we're going to go over today. So, Kim, you know what? Here's the mic. Go ahead.
Well, thank you, Tony. You know, investing in single-family homes versus investing in multifamily units is a different ballgame altogether. And one of the things that, one of the main considerations that I've found is you can grow your portfolio much quicker, obviously, in purchasing a multifamily unit. Because, you know, for the obvious reasons, you're buying 20 units as opposed to just one with a transaction. And so what you need to understand, though, is obviously all of the, you know, liability that's involved. You know, you're going to have more liability because obviously you have increased your risk by having 20 more tenants now as opposed to having one tenant, a larger property. It is also going to fall under commercial financing. And so you're going to need to understand through commercial financing, you know, there's some pros and there's some cons to that. The con, obviously, is you're probably going to have to put more money down. There's likely going to be a balloon at some point in time. It's not going to be a typical 30-year mortgage that you would get on a single-family home. However, the pro is you're only going to get one mortgage for, in this example, 20 units, as opposed to getting 20 single-family mortgages on something. So it is very cost-effective from that standpoint. But there's some key things that you really need to look at. And again, just like in you're purchasing any sort of investment properties, whether it be single family or multifamily, you want to have a strategy in place. Again, your why. Why are you doing this? Are you looking, again, for capital appreciation? Are you looking for monthly cash flow? Or both? Then you're going to have to surround yourself, get your strategy together, and then surround yourself with advisors, people in the insurance business, people, attorneys, financial advisors, good real estate agent that knows multifamily properties, and a good banker and a good CPA. So there's more things to be looking at, but there's some real key advantages in having multifamily. It makes sense now to hire a property manager. So you have less hands-on than you might have with a single-family property where you might be paying 10 to 12% of that income for someone to manage one property. Now, if you're paying 10 to 12% for somebody to manage 20 properties, it makes a lot more financial sense to do that. So there's some pros and cons, obviously, of any decision, any financial decision that you go to make. But let's kick this over now to the insurance aspect and to the considerations that you want to keep in mind when you are insuring a multifamily unit as opposed to a single family.
Yeah, Luke with Farm Bureau Insurance here. One of the pieces that surprises, especially new entries into this realm, is the time frame that it takes to underwrite the properties. For your single-family home, the day before closing, if you call your insurance agency and say, I need insurance on this property, as long as it's in good condition and qualifies, it's probably going to get insured that day. With larger apartment complexes, some of these things are valued at $1 up to $100 million in property that you're dealing with. You have banks, you have additional insureds such as property management companies. You might have some silent investors who want to be listed as additional insureds on the property who want the protection of the insurance policy. And all that stuff takes time to gather. It also takes time to gather valuations. Yes, you bought that 4-building apartment complex for $1 million, but if you want to rebuild it tomorrow, it's going to cost considerably more than $1 million. Property values, cost of construction simply just goes up day by day. It also takes time to get underwriters on board and check things like where the electrical's at, the condition of the property, when was the last time the roof was replaced, all these questions that when you get into it as an investor, you don't care, right? You say, well, I don't care when the roof is replaced. I want to buy this thing. I want to get cash flow going. Well, from a risk management perspective, the insurance company has to evaluate those things. And also, it's kind of a service that we provide to evaluate them for you, to say, did you know that this roof was replaced in 1965? Oh, no, I didn't know that. Well, you're probably going to need to replace it pretty soon. There's cupping, curling, there's issues. You could have water damage. Now you have tenants who are upset because they have water inside their apartment complexes. We catch things that on the front end with all that work that we do so that doesn't become an issue for you. And so I think the time frame on these is considerably longer. We've worked on deals where the banking ends up being even longer than the insurance piece. And so I think when it comes to time frame, there's certain things such as the process to get LLCs set up, the legalities on the back end that take a lot of work. If you have investors, I know there's some legalities around involving those investors in the property. John, could you speak to that, kind of that front end process?
Yeah, absolutely. And I think when we're looking at multifamily properties, I think the legal side of things is really amplified. You need to really be thinking from the very beginning, how am I going to hold title to the property? What are my risks? What's my potential liability? I think your leases need to be really tightened up because you're going to be entering into a much higher volume of tenants. I think you need to be very clear about who are the owners. Maybe you are going to be co-owners. There's going to be multiple owners. You need to think about those things. And actually, the area that I see that people miss the most is this concept of getting investors. I think that people generally, this is my experience, but they generally don't understand that there are certain things known as securities laws, where if you are making an offer or a sale of securities, and security is defined very broadly, and I know Scott could probably tell us about securities in terms of how he deals with them on a financial side, but actually a security is defined as giving someone money with the expectation of a return in which you are not going to do anything to get that return. That's a security. So if you are getting loans from people to put towards purchasing a property, that's absolutely a security. If they're not going to be active in that property at all, that's absolutely a security. And so the golden rule with securities law is this. This is very, there's thousands and thousands of pages and laws and regulations, but here's the golden rule. You either have to register your security with the state or the federal government or both, or you have to have an exemption. And registration typically is in the 7-figure price tag, so that's pretty much out of the option for someone that's getting started in this business, right? And so we need to find an exemption or some exemptions. And that's where you need a securities attorney, not even real estate attorney, securities attorney. And I have a lot of experience dealing with this, and sadly, I have a lot of experience with people who do this and they make a mistake. They don't follow the securities laws. And the remedies are, if you think about this, these are the remedies. If you engage in not even a sale, but an offer of a security, someone can get all of their money back, plus interest, plus attorney fees. So let's say you put an investment deal together for a multifamily property, and you spend the money to buy the property, but you don't comply with the securities laws. Now, all of a sudden, someone can sue you, and they have the right to get all of the money that they gave you back plus interest. The money's already gone.
John, this is Kim. Is it different if they purchase it? Say you wanted to buy a property and you said, hey, Kim, do you want to buy this property with me? I need to come up with $100,000. I'll put 50 and you put 50 in, and we'll both be title holders. Now, does that take that securities issue out?
No, not necessarily.
Okay.
Not necessarily. So that's why a lot of people, that might be a misconception. If they're not doing anything, if they're just putting in money, then it's clearly a security. Now, there are things you could do that would make it not a security, but that's where you really need to structure it on a case-by-case basis. It's very important. The other thing to think about is that it's not just getting the exemption, it's complying with it. So that's where you see these kind of big disclosure documents, these packets of documents. That's exactly what it is. You have to disclose all the risks, all the material risks. And actually, if you have a misstatement, what's called a material misstatement, which means basically, did you tell the investor everything that a reasonable investor would want to know before investing? If you fail to include certain things, and I'm not talking about on an inspection like disclosures like you do in like typical residential a transaction like that. I'm talking about risks to this investment. If those aren't disclosed fully, then you're subject to, like I mentioned, a personal or private cause of action where someone could sue you. You're also subject to the state. The state of Michigan has a very active securities enforcement division, and I've helped clients deal with this. And the minimum fine is $20,000.
Well, you've scared me half to death right now, and whether or not I should purchase a multifamily unit. Is there, Scott, can you tell us, are there financial advantages to be able to do this as opposed to, obviously taking into account hiring a good attorney and insurance agent ahead of time?
Well, sure. I mean, one of the reasons that people sometimes will get into this type of real estate is for diversification purposes. I mean, it's one thing to look right now at the stock market, being high and other things to say, well, I don't need to invest in anything other than that. Well, Mom always told you don't put all your eggs in one basket. So I think people do get to a certain degree of success with other more, let's call them traditional investments, even though dirt's been around as long as anything. So I would say maybe that's the original traditional investment. But diversification is a good reason, because then if you, and when we're talking about diversification, we're not talking about, say, a real estate investment trust now. A real estate investment trust is going to act an awful lot like a stock when stocks go down, because they are publicly traded securities. If they're not, then they're different. We won't bother to get into that right now. But the point is, diversification is a big reason. Obviously, the rates of return over time, as long as people do it right and take care of their liability. We haven't even talked about taxes yet. We've only touched really on some of the insurance issues. The rates of return can be quite good. And that's another reason. Why would people do it? Well, they think that their returns could be at least equal to, if not greater than, other investments that they can make. So, and some of that comes into play with taxes. You eat your net. So it doesn't matter what an investment's doing on a gross basis. If there are tax advantages, then that might amplify what you're able to take off as your net, so to speak. So there are diversification reasons. There's rates of return reasons. Frankly, I think some people get to a certain point in life where they like the challenge. They've sort of accomplished what they want to accomplish through their business, and they say, you know what, I would like to, I've seen other people do this. I think I can do it too. Now, obviously, you have to be careful in that regard, because, if you let one's ego get in the way of smarts, then you're in trouble. But it can be that too, where people say, look, I can do this. Again, surround yourself with the right team.
Exactly. Are there other issues insurance-wise that should be taken into consideration, Luke?
A big one is essentially how you insure the structures themselves. Are you going to rent it as an apartment complex? Are you going to form a condominium association where you're just perhaps insuring from the exterior walls out? Are you going to do it as an apartment complex, and now you are insuring the entire structure, the structure in its entirety? And then how would you like it handled if that structure is gone tomorrow? A meteor hits it and it's gone. What are you going to do? Do you want to rebuild it? Do you want to take the cash out? How is your operation agreement written? What is the plan long term? So there's such a thing as a replacement cost. That's a building valuation term. And then there's actual cash value. And actual cash value is essentially market cost. It's not always exact, but it's pretty close. And many times investors, because they have a large portfolio of properties, are okay with, if one burns down, I'd rather not deal with it. Let me take the cash out of it. I have other uses for it. But last I checked, God was not making any more land. And so that's not always the best idea, right? You may want to rebuild that thing, because there's not going to be another apartment complex available for sale every single day. Some of the other considerations are when it comes to tenants that you allow in. This comes down to having a really good lease agreement. Are you requiring your tenants to have renter's insurance, or are you partially taking on that liability if your building has a structural issue, damages their property? Who's going to be paying for that property? So those are the types of things that you have to consider when it comes to the insurance side. Deductibles is a big piece of it. If you're insuring millions of dollars in property, do you want $1,000 deductible on that property? For your homeowners, absolutely. Why would you take on more risk than you need to? But it's $1 million structure. Maybe a $5,000 deductible makes sense. Maybe a $10,000 deductible makes sense. But that comes down to liquidity of assets, how prepared you are, and how much work you've done on the front end going into it.
We're talking about, this is Kim, we're talking about the expenses that you need to consider. And one of the main things that people ask me all the time is, what should I consider to set aside for repairs and maintenance for a property? And we're going to get into that in the next one, but a good rule of thumb is right around 2% of your gross rents would be a good idea for that.
We will do that at the tail end of this edition of the Business Wrap, always available on our website, businesswrap.biz, Facebook, Twitter, also our One Touch app. Just go to your smartphone's app store and search Business Wrap.
You're connected to Business Wrap, inspiring ideas that propel the business community forward. Now, the conclusion of our roundtable discussion with Tony Cuthbert.
Right back at it here on the Business Wrap as we talk investing in multifamily real estate, joined in studio by a panel of experts, and they are
Kim Lafayette with Coldwell Banker Hubbell Briarwood and the Lafayette team.
Luke Mardigian, the Mardigian Agency, Farm Bureau Insurance.
John Mashney of the law firm of Foster Swift Kellens and Smith.
Scott Danek, Equanimity Wealth Management.
So we've discussed key considerations for investing in multifamily homes. Let's get into finding the right properties in the case for investing in these multifamily homes. Kim?
Well, again, you're going to have to go back to your strategy. What is your strategy? You're going to want to know that the area that you're investing in is going to have a good potential draw for tenants. You're not going to want to be in an area that has a low or a high vacancy rate. So you're going to be looking at a lot of different factors to make sure that you're getting into a good area. When I say good area, what I mean by that is a rentable area, an area where you're going to get tenants, where the vacancy rate, again, is going to be low. So, and that's something that your realtor can help you with, because they've got stats and they've got information on that particular property that they can look back on and see the history of. Once you find that property, you're going to want to look at your gross income. We had been talking about like a 20 unit. Well, actually, if you purchase anything from 1 to 4 units, even though it's a multifamily unit, 1 to 4 units can still be financed as a single family dwelling. So all of those same terms apply. You can get a 30-year mortgage, put 20 or 25% down. It's only when you get 5 units or more that you end up with commercial financing. So let's say you're looking at a duplex and you're able to, you can spend money on a duplex. Now you've got double the income coming in that you would on a single family, but it's not necessarily costing you double in price. And so the return on that might be a little bit greater. But again, you're going to want to take into consideration all your expenses. And we touched a little bit on the first one, repairs and maintenance. Figure about 2% of your gross income. So if you're making, not of the value of the property, not your gross income. So let's say the duplex is $200,000. Figure 2% of that and set that aside as your as your repair and your reserve money that you have set aside. But then again, you're also going to want to have probably about 6 months of reserves set aside just for capital, for any other things that you might have. Of course, you're going to have to get the rental registration, which most communities require. You may require a rental license in that area as well. You're also going to want to look at utilities. Who's paying the utilities? So you're going to take your gross income, and let's say, for example, your gross income is $2,000 a month. Many people make the mistake of only looking at what their principal, interest, taxes, and insurance are going to cost them, and they go, oh, my return is going to be X. You need to take into account other factors as well, the additional insurance that you might want to have, your umbrella policy, like Luke talked about. You're going to want to look at utilities. Who's paying the utilities? If the tenant's paying all of those, that's fine, but what happens if you have a vacancy? Now you've got utilities. So marketing fees, management fees. So you're going to take your gross income, and once you subtract all of these, you're going to have your net operating income, your net income at that point in time. Once you know what that net income is, then you can figure what your rate of return is going to be, but not before then, because you're not looking at a true picture at that point. So looking at all of those different factors, you're going to have more operating costs, you're going to have more responsibility, because now you've got more tenants, you've got more liability and so forth. Did we get a question that came in earlier about the...
Yeah, there was this is John from Foster Swift. There was a question just about how do you... is business income considered an asset when we were talking previously about the amount of equity that's in an entity. And essentially, it's any asset that is in that entity. So if you have a bank account that's titled in that entity, then any money in that bank account counts as asset that's owned by that entity. So, of course, any money that you have in an LLC bank account is going to count towards the equity in that bank account. And let me add one thing, too, thinking through the calculation of expenses and actually figuring out your net return. One area that really pushes people into real estate, from my perspective, is that they look at their tax return and they see actually how much they're paying in taxes. And the truth is that the individual taxpayer is the highest rate of tax that you can pay in the U.S. tax code. And for fun, I teach tax at Cooley Law School, so I love to talk about taxes, so I can talk about that as much as people want. But I will say that the tax advantages for real estate investment are incredible. And really, the tax code is written to incentivize people to own property that helps other people have a lower cost of living through rentals and things like that. And the tax benefits are amazing, but you have to take advantage of them. And you can actually include them in the calculation of your net income. And I think you should, because if you don't, you're really missing out on some of the big benefits of owning multifamily property. It's single family as well, but when you're dealing with multifamily, then it becomes a bigger part of your rate of return. Like, for example, if you are an active investor, or what the tax code qualifies as an active investor, it makes a big difference in terms of how much you can deduct on your tax return for certain expenses. If you're a passive investor, then you have to think about things a little bit differently in terms of what you can deduct right now. Furthermore, there's certain things called a 1031 exchange, where you can actually defer the capital gains taxes when you're selling your property if you follow the right procedures. And there are circumstances where you could defer continuously over and over and acquire larger and larger properties and not pay tax until you finally sell or dispose of the property. Now, there's other strategies where if you can donate or you give that property to your kids or to the beneficiaries of a trust or will, you can actually eliminate all tax on property just by following some procedures that are very clear. It's not tax evasion. The tax code's written to incentivize these types of things. So the tax benefits can actually double, triple your rate of return, but only if you follow what the tax code allows. If you don't even know what the tax benefits are, then you are going to be in trouble. Like, for example, you can deduct education. You can deduct certain expenses like mileage, where if you don't have a business, you don't have a similar type of investment project, you're not going to be able to take those deductions. You can't deduct the miles that you drive to work. But if you're working on a business, then you can. And so this is, from my perspective, that should be part of the calculus when you're figuring out your rate of return.
You know, and so many people look at the cost. They say, well, you know, I really don't want to have to pay for, and I tell them, this is not a cost to you. This is going to be a savings for you, because too many people don't know what they don't know. And so you may be taking just what you think of as the standard deductions if you're doing your taxes yourself. However, if you have a good CPA, it's amazing of the savings that you will get on that. Now, we had a question from one of our listeners, and it says, is it smart to buy in a college town when maybe half the year, 3 months out of the year, you're going to have vacancies? And I'm going to defer back to my answer that I give on just about any real estate thing. It depends. It depends on the price. It depends on the vacancy rate. And again, you can look at the vacancy rate because they're still rented out during the summer months, but they're not getting as much money. So you're still looking at the numbers. And so again, it does make sense, because you know that for 9 months out of the year, you're going to have a waiting list in many cases for students to get in there. Now, typically when you're renting to students in a college town, you're going to have higher expenses too, because they really don't treat them, because they're young kids that are moving into a place. It's not necessarily a professional or a family that's living in a place that takes pride in where they live. They're in there, I think of Animal House, you know. So you're going to want to be careful and just know about that. So you might want to have a little bit more than 2% set aside for your repairs and maintenance, because you may need that in a college town. But again, it depends on the pricing on it, and it depends on your aversion to risk or not. So if you are not so concerned about the risk factor, if it's not going to make you ill, like my husband, when a tenant moves out, my husband gets physically ill because he took such good care of this and it was in such beautiful condition. I go, honey, get over it. This has been going on for 35 years that we've owned rental properties. This happens every time there's a vacancy. You know, this is the definition of insanity, you know. Doing the same thing over and over again, expecting different results. Nobody's going to take care of your property the way that you take care of the property. You need to get that in your head and understand that, plan for it, have that money set aside for it. But there is going to be more of that risk when you are in a college town, has been my experience.
And John, this is Scott with Equanimity Wealth Management. If you don't have to go necessarily into all the details, but when you mentioned 1031 and you mentioned the ability to defer taxes on sales, obviously a lot of people's ears might perk up. But just sort of like we were talking earlier with Luke, it takes longer to insure, etc. There's some pretty specific time frames, and there's some pretty specific things you need to do to make a 1031. Can you touch on those just briefly so that people at least have a long-term idea of, wow, I got to be thinking about this well before?
Right. Yeah, absolutely. This is John. So when it comes to a 1031 exchange, the first thing I would say is you shouldn't just be thinking, oh, I want to sell my property. Oh, I'd like to defer the taxes. So let's try a 1031 exchange. This should be part of your strategy that you've taken the time to think about before you even bought one property. Because a 1031 exchange does have some incredible tax benefits. But what it allows you to do is buy, if you own property, you can sell the property to what's called a qualified intermediary, and then that qualified intermediary can buy new property that is greater or equivalent price, and you can defer the capital gains. However, there's different types of 1031 exchanges. But in some cases, you have to identify the property within a certain period of time. So you can't just say, I'm going to sell it, and then I have a few years to figure this out. In some cases, it's 45 days. In other cases, it's 180 days. But the bottom line is this should be part of your strategy so that you know the unique characteristics of the strategy and that you're already thinking about it. So, for instance, if you want to buy a property and hold it for 30 years, then you're probably not going to be thinking, oh, I want to learn all about 1031 exchanges. But if part of your strategy is to sell within 2 to 5 years and take that money, invest it into a bigger, more valuable property, well, then absolutely, you should learn the ins and outs of 1031 exchanges. And don't try to read the tax code yourself if you've never done it. You will lose your mind and you will make a mistake. You need to work with attorneys and real estate individuals who specialize in 1031 exchanges. And it's actually not hard and not very expensive. But there are certain timelines. You have to identify a certain number of properties within a certain period of time, and then you actually have to go through and purchase one of those properties. So it can be easy to mess up, but you can easily comply with those very specific requirements if you have people advising you. And I think that's my kind of message overall is make it part of your strategy, learn the ins and outs of the strategy to get the best bang for your buck.
The devil's in the details.
Exactly.
Absolutely. Yep.
And that's why it's so important to have these individuals in your team, to have them assembled. You don't want to go out and start searching for these people when you need that particular service. I've done several 1031 exchanges with my clients over the years, and they're very simple processes really to go through, but you have to know to put them in touch with the right title companies, the right attorneys, and so on to be able to do that.
So one thing I wanted to get back to, this is Scott with Equanimity Wealth Management. We'll go back sort of to the beginning of this segment. Luke, you'd said you need to take more time if you're going to be purchasing the multifamily homes as an investment. Can you give the listeners an idea of, because you had said sometimes if it's a single, you can just same day call up. Well, more time could be 2 days. More time could be a week. You just never know. So I always like to give people a sort of a conservative estimate to say, look, you really need to be thinking about this 2 months before you think you might be closing, 3 months before. Do you have a general idea of if I've identified one of these properties, but I want to give you enough time to do your job to help me get it properly insured, etc., what's kind of the lead time that's fair to you and to the insurance company to properly do your job?
These transactions take longer than single families in general, right? So as soon as you're saying, I'm meeting with an attorney, I'm meeting with the lender, your insurance person should be involved. And you want somebody who's experienced in insuring apartment complexes, because the perplexity of this thing, it just starts to get mind-boggling when you start throwing in things like amperage to the building. If you have a property management company, what kind of reputation do they have? Are they throwing salt down all winter, or are they just doing it once a week? All that risk plays into it, because even though, as John said, there's a lot of tax advantages, we still don't want to pay more for insurance than we need to, right? And so involving the insurance agent early in that process and having them talk about all the specifics leading up to the closing of the property is a huge advantage to the investor.
So not an afterthought, simultaneous with.
Absolutely.
So there you have it, investing in multifamily real estate here on the Business Wrap. A big thank you to our experts today, and they were
Kim Lafayette with Coldwell Banker Howell Briarwood and the Lafayette team.
Luke Mardigian, the Mardigian Agency, Farm Bureau Insurance.
John Mashney from the law firm of Foster Swift, Collins & Smith.
Scott Danick, Equanimity Wealth Management.
My name is Tony Cuthbert. A big thank you to the producer, Morgan Hall. And we close each show with our founder, Suzanne Heward. And she says,
That's a wrap.